Scott Corporation sold a fixed asset used for operations for greater than its carrying value. So that means your disposal value is greater than your carrying value. That means there is a gain on disposal. Scott should report the transaction in the income statement using net concept, means you need to disclose either the loss or gain, true. Showing the total amount as a component of other comprehensive income, not the total amount, just the gain only, and not in other comprehensive income, wrong. Net concept, showing the total gain, yes, as a part of continuing operation and not net of tax, true. This is the correct option. Net concept, yes, showing the total gain as a part of discontinued operation. This is not discontinued operation, wrong. Gross concept, not at all. So this is the right combination. You need to report the net gain or loss in the continuing operation and without any net of tax impact. So that's the right answer. In DART Company's Year 2 single-step income statement as prepared by DART's controller, the section titled Revenues consisted of the following. In Year 2 single-step income statement, what amount should DART report as a total revenue? Remember, in a single-step income statement, we report all the revenues and expenses in just two categories, and there is no gross profit or operating profit, just these two numbers. So what we have, so the total revenue includes your sales of goods and services, yes. It includes rentals, it includes other incomes, but no purchase discounts, no recovery of accounts written off. If any bad debt which was previously written off, if it is recovered, you debit bank or cash. Credit allowance for uncollectible account, it has nothing to do with the income statement. So only number that you would report as revenues is 250, that is D. During January Year 3, Doe Corporation agreed to sell the assets and product line of its Heart division. The decision represents a major strategic shift for Doe and will have a significant effect on its operations and the financial results. Alright. The sale was completed on January 15th, Year 4, and resulted in a gain on disposal of $900,000. Heart's operating losses were $600,000 for Year 3 and $50,000 for the period 1st January through January 15, Year 4. Disregarding income taxes, what amount of net gain or loss should be reported in those comparative Year 4 and 3 income statement? First of all, you have two important aspects to it. There are operating losses in Year 3 and 4, operating losses, and then finally when you dispose of the asset, this division on 15th of January Year 4, there is a gain or loss on disposal itself, gain or loss on disposal itself. So what you're going to do, you're going to report this 600,000 operating loss in Year 3 and this 50,000 loss in Year 4 together with the gain and loss of $900,000. So this is the operating loss for Year 3 and this operating loss for Year 4 plus the gain on disposal gives you the net figure of 850, and that makes C to be the correct option. One of the elements of financial statement is comprehensive income. Comprehensive income excludes changes in equity resulting from which of the following? Remember, comprehensive income includes all changes in equity during a period except those resulting from owner's investments. Owner investments mean issuing additional common stock and corresponding additional contributed capital or additional paid in capital plus any dividends. So these are the transactions with your shareholders. Issuance of stock resulting in additional accumulated contributed capital, additional paid in capital, or dividends paid to shareholders. Anything other than this becomes part of comprehensive income. That is, comprehensive income itself is equal to income statement plus other comprehensive income. So you remember from the lecture. So clearly this is it. Dividends paid to shareholders. This is it. Your comprehensive income excludes these, and the question specifically asks us to find what is excluded. On September 22, Year 4, Yumi Corporation purchased a merchandise from an unaffiliated foreign company for 10,000 units of foreign company's local currency. On that date, the spot rate was 0.55 per foreign currency. So that means 0.55 times 10,000. This is the recorded liability on the date of transaction. On that date, the spot rate was this already considered. Yumi paid the bill in full on March 20th, Year 5. when the spot rate was 0.65. That's the settlement date. The spot rate was 0.7 on December 31st, year 4. What amount should UMI report as a foreign currency transaction loss in its income statement for the year ended December 31st, year 4? Now consider there are two dates. One is the balance sheet date, right, 31st December, year 4, and then the settlement date, that is given here. Settlement was made on March 20th, year 5. So the point is, on the balance sheet date, the rate was $0.7 per foreign currency unit. That means the liability had a fair value of $7,000, which means there is a transaction loss. You report a transaction loss of $1,500, that is the answer. Going one step further, this is the recorded liability on the transaction date. This is the recorded liability on the balance sheet date, incurring a transaction loss of $1,500. But when we settle at that date, the rate was 0.65 per foreign currency unit, and we settled the liability for $6,500. Now, this $500 would be the transaction gain. So, on balance sheet date, this is $1,500 foreign currency transaction loss. On settlement date, there is a gain. So, please do this question a couple of times so you get a better understanding. A company's year-end comparative statement of financial position reflects the following changes from the prior year. Cash increase, total liabilities increase, other assets decrease. Which of the following statement is correct regarding the current year's change in the company's stockholders' equity? We know assets is equal to equity plus liabilities, and if we rearrange the equation, equity is equal to assets minus liabilities. Just solve this, you'll get your answer. It says your cash increased by $40,000. Great. And at the same time, your total liabilities increased by $32,000. Right? And at the same time, other assets decreased by $65,000. So what you have now, there is an overall decrease in assets of $25,000 and increase in liability $32,000. So technically, your equity has decreased by $57,000. Simple linear equation, you get your answer. Gar Incorporated's trial balance reflected the following liability accounts balances at 31st December. It says the deferred income tax payable is based on temporary differences that will reverse in year 3 or 4. In GAR's December 31st, year 1 balance sheet, the current liability is total. Accounts payable is a current liability. Bonds payable due next year is a current liability. True. Deferred income tax liability, no, it's a non-current item. Discount on bond payable needs to be netted off against this number. So we have 19,000 as our accounts payable as a current liability. 34 less 2 discount payable, discount on bonds payable. So that's 32. That is your current liability because they are payable next year. Dividend payable is your current liability. Income taxes payable is your current liability. But notes payable due on January 19th, year 3, that's a long term or non-current liability, long-term liability. So totaling these 19,000 plus 32 plus 5 plus 9 gives you a total of $65,000. This is the figure for your current liability. Brock Corporation reports operating expenses in two categories: selling and general and administrative expenses. Fine. The adjusted trial balance at December 31st include the following expenses and losses. One half of the rented premises is occupied by the sales department. So anything related to sales, rented premises, one half goes to selling expenses. So it says total selling expenses are accounting and legal, that is part of your general and administrative. Advertisement, yes, it's a selling expense. Freight out, yes, it's a selling expense. It is not an operating expense, it is reported after operating expenses. So this is again ignored. This is your general and administrative expense. We are specifically looking for selling expenses. Loss on sale of long-term investment. Again, this has no relevance with operating income. It is reported in other income and expenses. Ignored. Officer salaries, general and administrative. Rent for office, yes, one half goes to selling expenses, and salaries and commissions of sales related expense. This is again selling expense. So if you take this 150, 80, then you take this half of it, that is 110,000 and 140. If you add all these, what you get is 480, and that's your answer. Accompanying activities for year 2 included the following: gross sales, cost of sales, selling and admin expenses, adjustment for prior period adjustments, that is understatement of amortization expense, sales return, gain on sale of available for sale securities, gain on disposal of discontinued business segment, and unrealized gain on available for sale debt securities. The company has 30% effective income tax rate. What is the company's net income for the year? Let's do it. So here we go. We got gross sales. Gross sales is 3.6 million less our sales return. So the net figure is 3.56 million. Then we have the cost of goods sold given, put right there. So this is your gross profit. Okay. Then you have selling and administrative expenses. After deducting, get your operating profit. Fine. Then we have our other gains and other income, gain on sale. This is it. We've got gain on sale of available for sale security. That is the realized gain. Income from continuing operations. Now we need to pay tax at the rate of 30%. This is the tax figure. And that's the income from discontinued operation after tax. Then we have this part. Gain on disposal of a discontinued business segment, 4,000. Since this is an after-tax number, so we need to report this gain on after-tax basis. So that's just simply 4,000 into 1 minus 30%. That will convert this into after-tax 2,800. And that's your net income for the period C. The question is, why are we ignoring this? Unrealized gain on available for sale debt securities. It's an OCI item, hence it is not included in the calculation of net income. It is reported as a component of other comprehensive income. Envoy company manufactures and sells household products. Envoy experiences or experienced losses associated with small appliance group. Operations and cash flows for this group can be clearly distinguished from the rest of Envoy's operations. Envoy plans to sell the small appliances group with its operations, discontinued operation. What is the earliest point at which Envoy should report the small appliance group as a discontinued operation? This is important part here. The earliest period the component of an entity can be reported in discontinued operation is when the component meets the following held for sale criteria. 1. Management commits to a plan to sell the component. 1. The component is available for immediate sale in its present conditions. Then an active program to locate a buyer has been initiated. Then the sale of the component is probable and the sale is expected to be completed within 1 year. The sale of the component is being actively marketed and it is unlikely that significant change to plan to sell will be made or that the plan will be withdrawn. These conditions must be met. So what is the earliest point at which Envoy should report the small appliances group as a discontinued operation? Not when we receive an offer, not when the majority of assets are sold, not when any first asset is sold, rather when we classify it as a held for sale. This is the point we just discussed, the conditions when we can report it as a discontinued operation. The current exchange rate is 1.59 US dollars per British pound. If a retailer in Great Britain were to quote the exchange rate using the direct method, he would. Remember, if you are in Britain, how would you quote the exchange rate under the direct method? You are going to give how many pounds per dollar, how many pounds per euro. This is not it, it's 1.59 US dollar per pound. So this is basically the indirect rate for him. For him it's indirect rate, that 1.59 US dollars per pound. Direct rate would be simply 1 upon 1.59. If you simplify this, this will give you 0.63. So 0.63 pounds are worth $1. This is the direct method. This is the indirect method. Take the example for in India, the dollar is 83 Indian rupees per dollar. This is the direct method in India. If you are in India, you report Indian rupees 83 per US dollar. This is the direct method. Same as for a person in Britain, it's 0.63 pounds per dollar. This is the direct method. Noshima, a Japanese company, exports goods to Jacobs. So Noshima is an exporter and Jacob is an importer based in US. If transaction is to be settled in yen, which of the following statement is correct? Let me make a table and explain the idea, and this will be very helpful for you to solve any question involving exchange rate volatility. Noshima is to receive yen, Jacob
is in the US, so he will have to sell dollars to buy yen. So what happens if a yen appreciates against dollar? The bigger sign of yen means it's appreciating against dollar. So then Noshima gains. Conversely speaking, when dollar appreciates against yen, then Jacob wins because he will have to give fewer dollars to settle the liability. Conversely speaking, if dollar appreciates against yen, Noshima loses. And if yen appreciates against dollar, Jacob loses. This is very helpful. This comparative size of yen and dollar will help you understand the idea. Let us see these options one by one. Jacob will book a gain if yen appreciates versus the US dollar. This is incorrect because if yen appreciates, Jacob will lose. He will have to sell more dollars to buy yen, so this is incorrect. This is incorrect. Noshima will book a gain if US dollar appreciates. No. If US dollar appreciates, then fewer US dollars will be able to settle the liability. He loses. He loses. He will get fewer yens. Then Noshima will book a gain if Japanese yen depreciates versus the US dollar. If it depreciates, again it's a loss. If yen depreciates against the US dollar, Noshima suffers a loss. Jacob will book a gain if US dollar appreciates. Yes, Jacob will benefit if US dollar appreciates because he will have to give few dollars to settle the liability. This is absolutely right and this is the correct option. Always make a table like this. It doesn't take much time. Then you can, even first line is enough. If you make this line and you just forget about gain losses, you can just get an idea which currency when appreciates benefits whom. It's much easier to manage. Which of the following statements regarding comprehensive income is correct? Let's move in the reverse order so you get good understanding of each option. Comprehensive income must always be equal or exceed net income. This is not true because if your other comprehensive income has significant losses, then the overall comprehensive income might be less than the income statement. So this is not true. It could go both ways, but this is incorrect, that it was always equal or exceed the net income. If there are more losses in OCI, then the overall comprehensive income will have a less figure than the income statement. Wrong. Other comprehensive income is a permanent account. Wrong. Accumulated other comprehensive income is a permanent account which is reported as a part of equity, not other comprehensive income, which is wrong. Accumulated other comprehensive income never gets closed and it is shown on the balance sheet. But other comprehensive income is a part of statement of comprehensive income and its balance is transferred to the accumulated other comprehensive income. Discontinued operations are the last item recorded in comprehensive income. Wrong. Discontinued operations are reported as a part of income statement, not in other comprehensive income. So then it has to be A. The relationship between net income and retained earning is analogous to the relationship between comprehensive income and accumulated other comprehensive income. This is absolutely right. Absolutely right. Net income closest to retained earning. Similarly, other comprehensive income balances go to accumulated other comprehensive income. And these two are permanent accounts on your balance sheet under the statement of changes in equity. This is the right option. On June 19th, Dawn Company, a US company, sold and delivered merchandise on 30-day account to Cologne, a German corporation, for 200,000 euros. On July 19th, Cologne paid in full. Relevant currency exchange rates given as follows. We have been given the spot of dollar against euros and 30 days forward. That is, this is the direct rate, $0.988 per euro. And this is the spot on July 19th. This is the 30-day forward on 19th of June, and this is 30-day forward rate on July 19th. What amount should Dawn record on June 19th as an account receivable for its sale to Cologne? Now, the important point here to note is that we take spot rates on the day the transaction was entered into. So 200,000 euros at a rate of $0.98988 per euro. So if you multiply 200,000 with this, you get 197,600. This is the amount of liability. You're going to debit purchases or inventory, credit accounts payable with 197,600. That makes D to be the correct option. On 31st of October year 1, a US auto parts company purchased brake pads on credit from Canadian auto parts wholesaler supplier for 250,000 Canadian dollar. The Canadian supplier will be paid or settled on January 31st, year 2. The following US dollar per Canadian dollar exchange rates are as follows. So this is the direct rate, 0.90 US dollar per Canadian dollar. This is the direct rate on the date of transaction, on the date of balance sheet closing, and on the date of settlement. What is the journal entry, if any, made on the balance sheet date, that is December 31st, year 1, by the US Auto Parts Company, assuming the initial journal entry was made on October 31st, year 1. First, you have to make the journal entry on 31st of October, year 1. Then this will clarify the idea. So on the transaction date, these 250,000 Canadian dollars are equal to 250 times 0.90, that is 0.9 US dollar per Canadian dollar. So the liability you record is purchases debit 225 US dollars divided by accounts payable 225,000 accounts payable credit. Now what happens on the balance sheet date? Now the value of this liability is 0.85 times 250,000 Canadian dollars. It is 212,500. Clearly this is the liability on the date of transaction. This is the liability figure on the balance sheet date. Clearly there is a reduction in liability. There is a reduction in liability. You debit the differential. 2 to 5 less 212.5 is 12,500. And this is the foreign currency transaction gain of 12,500. And that would be accounts payable debit and foreign currency transaction gain credit. C is the answer. Ignoring taxes, which of the following situations will cause comprehensive income to decrease? A dividend payout to company shareholders. This goes from your retained earnings, so it has no impact on your comprehensive income. Wrong. An unrealized gain on available for sale security. This gain is reported in other comprehensive income. So when your other comprehensive income goes up, your comprehensive income goes up. We are looking for a situation where the comprehensive income decreases. The amortization of an actuarial pension loss. Please note, actuarial losses are initially recorded in accumulated other comprehensive income, and then they are gradually amortized into the pension expense over the period. The entry we make is we debit pension expense and credit the accumulated other comprehensive income. So what it says which of these will cause statement of comprehensive income to decrease. So what you see is that your income statement is being debited and OCI being credited, so the net impact is 0. So your comprehensive income neither increases nor decreases. So incorrect. Then we have unrealized loss on trading security. Yes, this trading security loss is reported as a part of income statement. A lower income statement means a lower or a reduction in the comprehensive income. That is the correct option. Which of the following items is included in accumulated other comprehensive income or losses? Unrealized holding gains or losses on securities classified as trading securities. This is incorrect because this is reported as a part of your income statement. So this is not an OCI item. Prior service costs not previously recognized as component of net periodic pension cost. Yes, this is it. Prior service cost recognized in the year of adjustment should be recorded in the other comprehensive income. It is one of the 4 components we discussed earlier, and hence it becomes part of accumulated other comprehensive income. A reduction of shareholders' equity related to employee stock ownership plans. This is wrong because when we grant share options to our employees, it is charged as an expense, as a compensation expense in income statement. So this is wrong. Unrealized gains and losses from derivative property designated as fair value hedge. Please note, this is important. Any gain and loss on fair value hedge is reported directly as a part of income statement. However, gains and losses on cash flow hedge, they are reported as a part of other comprehensive income until the hedge transaction results in some actual losses. Moving on. A company reports the following information as of December 31st. Sales revenue, cost of goods sold, operating expenses, unrealized holding gain on available for sale debt securities net of tax. What amount should the company report as comprehensive income as of December 31st? The first thing is that this part gives you bottom line of income statement. That is 800,000 less 600 less 90, that's 110. and this is the one of the components of other comprehensive income, which is a gain clearly. So that is it. So income statement plus OCI is the comprehensive income of 140. So that's the question. What amount should the company report as comprehensive income? 140. C is the answer. For the fiscal year ended September 30th, year 1, Safe Instruments Company reported net sales, gross profit and operating income of this respectively. The company also reported net interest expense of this, had a tax rate of 40%. Other pertinent income statement items included discontinued operation 20 million loss net of tax. If SIC, that is Safe Instrument Company, had other comprehensive income totaling 3.5 million during the fiscal year, what is the company's reported comprehensive income for September 30th, year 1? So we need to start from not gross profit, start from operating income. So this is the operating income. I'm going to put numbers in millions. So you have your operating income 135. You have interest expense given right here, that is given 45. So this is the income from continuing operation before taxes of 90 million. Income tax at the rate of 40%, that is 36 million. So income after tax is 54 million. And then we have a loss on discontinued operation of 20 million. That gives you 34 net income. And then we have, it says, other comprehensive income totaling 3.5 million. So then your total number for income, comprehensive income, it is 37.5 million. That is your option D. Lift Incorporated has the following 4 holdings in its portfolio of marketable securities. Question is, which of the following events will impact other comprehensive income balance? Okay, we have bond W classified as available for sale security. Yes. Available for sale security, any gain and loss, unrealized gain and loss, it is reported as a part of other comprehensive income. Look no further. Look no further. If there is any unrealized gain and loss on available for sale debt security, this unrealized gain goes to OCI. It says bond X is sold prior to maturity for a loss, income statement. Stock Z is sold for unrealized gain in the current year. Bond Z is basically trading securities, income statement. Bond Y has an unrealized loss for the year. Unrealized loss on trading security goes to income statement. So that is right. Bond W has unrealized gain and it is classified as available for sale security. It goes to other comprehensive income. The company reported the following information. What is the amount of other comprehensive income? Net income is a part of comprehensive income, but it is not the other comprehensive income component. Other owner's contribution is clearly not. Deferred gain on cash flow hedge. Yes, this is the part of other comprehensive income. It's a gain to be added. Foreign currency translation gain is a part of OCI to be added. Prior service cost not recognized in the net periodic pension cost. It is a loss in OCI related to defined pension benefit plan. So this is deducted. So 8 plus 2, 10, less 5, 5. D is the answer. Which of the following is an accurate statement regarding tax reporting issues pertaining to other comprehensive income items? The income tax expense or benefit for each other comprehensive income, those 4 items, translation gains, foreign currency translations, gain and loss on available for sale debt securities, then pension, gain and loss, defined pension obligation. And then we have the gain and loss on effective portion of cash flow hedge. So these are the 4 items. Any gain and loss related to it, each of these items must be disclosed on the face of financial statement that these components appear. This is wrong because company may also choose to disclose in the footnotes instead of financial statements. B, the income tax expense or benefit of each other comprehensive income must be disclosed in the footnotes to financial statement. Wrong. Company may choose to display them within financial statements where these components appear. Wrong. D, the individual components of other comprehensive income must be reported on net of tax basis. This is wrong as well. Company can also report the aggregate tax impact as one amount after the individual other comprehensive income item. So this is wrong also. So then right option is clearly C. The individual components of other comprehensive income may be either reported on before tax basis with aggregate tax amount reported after these amounts, or individually on net of tax basis. So this is the allowed combination of options, and that's the right answer.